I think over the next 2 or 3 years, we are going to have a credit crisis. The difference between this credit crisis and the one which I compare it with, which was 1929 to 1932, is the fiat currencies are unbacked this time, whereas in that earlier period, they were backed by gold. So the price effect is very, very different. Now, the question is, if you are, let's say, a holder of money deposits in a bank, and the bank is restricting the pace at which you can take out cash, and you may not want cash anyway, what do you do? Well, the answer is basically you get rid of your currency by buying something. Mm-hmm. You hedge out of it, if you like. And for the first time in all history, we have this paper digital alternative called Bitcoin. And the thing that is also important is that in understanding Bitcoin, you have a whole new generation, a literate, financially literate generation, who have learned about the disadvantages of fiat currency and how fiat currency is a liability of the government. And it only has any value so long as you trust that government, the issuer. So they have begun to understand in a way in which we haven't seen before, as there's a significant element of the general public who now know that paper currencies are going down the toilet. When they begin to see that happening, then they are going to accelerate their movement out of the paper currencies into alternatives such as Bitcoin. Now, Bitcoin doesn't replace gold and silver, because gold and silver is still the true money, if you like, for communities around the world, even communities who are not connected to each other. It is the one thing which everybody understands is not only a store of value, but it will be accepted in exchange for goods and services by other people without question.
After I order gold or silver, how can I trust I'm going to get it? And I don't want everybody to know that I'm ordering gold and silver.
Oh, it's okay. It's fully insured. It's trackable, and you have to sign for it, so nobody else is going to get it but you. And it comes discreetly packaged. If you order a small amount, like maybe gold, it'll probably come in a box that looks something like this. Okay. And if you order a large amount, maybe like silver, it'll come in a box that looks something like this.
Wow.
But it doesn't say gold or silver on there. It might say something industrial or something else like that, but nobody's going to know what you ordered.
Oh, that's great to know.
Your first ounce of silver is at spot price, and you get free shipping on any order over $99 at sdbullion.com/RP. Reluctant Preppers provides educational awareness and commentary only. Opinions expressed do not constitute personalized financial advice. Viewers are encouraged to do their own research and seek qualified personal financial consultation before making investment decisions.
As a responsible person with growing concerns for your privacy and personal liberty, you want to know where we're headed and what you can do about it. We ask the experts what you need to do to take prudent and responsible action to safeguard your family's wealth and well-being, and what basic first steps will help you to be aware and prepared. ReluctantPreppers.com.
Welcome back, Reluctant Preppers. We have a returning guest, Alasdair MacLeod, the head of research at goldmoney.com, back with us again today. Alasdair, thank you for joining us.
That's very much my pleasure, Donegan.
I asked if you could join us again this time because I was intrigued by a recent article that you penned called "A Whale is Accumulating Silver Futures." You went into some great detail into the Commitment of Traders report and some of the details behind that can reveal, if for those who are patient enough to pull them apart, what's actually happening on some of the largest and most influential trading positions on the silver futures, and what it might indicate about the potential future direction or that people need to be aware of for the silver market. And it's stirred a bit of controversy in the silver community. So if you could first take us into what got you, I'm sure this is something you watch a lot and you watch all the time, and that's why we love to have you giving us your insights, but what specifically sparked your attention that's unusual that you're observing at this time? And I should mention, folks, today is Tuesday, July 16th, 2019.
Well, I think I don't actually follow silver all that closely. My interests really are gold. Sound money is first and foremost, really, and sound money is gold. Silver, if you like, is a secondary activity as far as I'm concerned, but it is nonetheless an intriguing market. And I just happened to notice that there was this big difference between what's been happening between the 4 largest traders and the next 4 largest traders. The 4 largest traders are net long. I think it's something like 9,000 contracts, while the next 4 traders are pretty much record short. Now, this is just extraordinary. So it was really that got me interested. And my interest sort of goes back to, it's around about 2012, I think. I was in New York at one of the sort of metals and mining conferences. And I just had a sort of inkling that, all this talk about JP Morgan, and you had all the sort of the conspiracy theorists and the so-called experts, some, not all of them, but some of the so-called experts on commitment of traders figures, were saying that JP Morgan is rigging the markets and all the rest of it. Andy Maguire came up with some evidence of rigging, I don't think that's quite the subject that we were talking about. I mean, there is no doubt about it that you have very, very large traders in the market. They can dominate the market, and they can move the market very, very sharply in their favor. And of course, as innocent, ordinary people, we don't like it. But if you're going to play in a market where there are several of these big whales, if you like, then I'm afraid it becomes a fact of life. But anyway, what particularly interested me back at that time was I had a theory that the emerging big buyer of silver in terms of importing from abroad was clearly China. So I just sort of wondered, what actually happens on the ground if you're a silver miner, say in Bolivia or Mexico or something like that. And there were about, I suppose, 6 or 7 silver mines exhibiting at the show at which I was speaking. So I went round and I asked them, I said, what actually happens? How do you ship your silver out and how do you get paid? And it emerged, every one of them told the same story. And that is that rather like the man from Del Monte comes to inspect the peaches on the tree, the man from Glencore came to assess the silver content of the doré. And then what happened was that they would get a check from someone like JP Morgan to pay for the doré once it was shipped off site. So this is a wonderful arrangement for the small silver miners because they were always struggling with cash flow. I mean, it is the nature of mining. You've got miners to pay, you've got electricity to pay, you got this, you got that, security, everything. So you do actually need to pay the bills. And here was this system which was set up to help these guys. So I looked into it a bit more and I sort of thought it through. And I thought, well, it does actually seem to me that China, if you like, or a Chinese agency, particularly the People's Bank, is likely to be JP Morgan's underlying client. And it's not just the small silver producers we're talking about, because exactly the same process helps with the bulk of ore which is shipped into China, which is base metal ore, copper, zinc, lead, and so on and so forth. That is shipped into China with various metals in the ore content, including silver, which is assessed. So you've got these huge imports going in. And what I was seeing was just a little tip of the iceberg, if you like, with these 6 or 7 exhibitors at the show in New York. So I sort of worked out my own conspiracy theory, and I call it that because I have no firm evidence that this is the case. It is merely deduction, and I hope reasonable deduction. So that I stuck in the back of my mind for quite a long time. And then I see the situation where suddenly, amongst the 4 largest traders, there appears to be a very, very big long, when you would expect them all to be short, because the 4 largest traders are usually commercials, such as a large mine, which is hedging, but it most likely wasn't that, or bullion banks. And then, of course, you're talking about the JP Morgans, you're talking about HSBC, and so on, and so on, and so on. Now, much of their activity will appear in the swap market. Why? Because the swaps basically are hedging from elsewhere. And that elsewhere, obviously, is London. London is a far bigger market than COMEX in silver futures. The London forwards dominates silver. And what happens then is that, okay, let's say JP Morgan is doing business for its client, which we'll say for the sake of argument is the People's Bank of China. Most of the business they're probably doing actually is in London, not on COMEX. But what you see is that if we go back to the time when I allege that the People's Bank of China was effectively hedging its silver as it was buying it, with the advantage that as you hedge, you drive the price down because your hedges do that work for you. They were probably doing it in London in the forward market. So what would happen is that they would see a shipment coming in, say, from Australia of mixed ore, including silver. They would know the silver content of that. They would know how long it takes to process. And incidentally, the whole of the refining and processing, silver processing industry in China is government controlled. So if in effect this is government through its central bank. This is what I'm suggesting.
And just so we're clear and we understand, you're saying that the way this works is that wherever the mines are located, they actually ship the ore across the ocean to China for refining?
Yeah, and it may be partly refined, whatever. I mean, but the point is that it is assayed abroad by our man from Glencore, who then, on the back of his expert assessment, the miner can be paid by JP Morgan.
Gotcha.
Okay, but JP Morgan isn't doing this on its own book. And I'll come to that point in a second. It isn't doing this on its own book. It's doing it for a very important client. Now, that's the key to it. So you've got this sort of huge amount of ore being imported into China and the payment going through. And at the same time, before this long position built up, at the same time, what you had was JP Morgan, on behalf of its client, selling futures, selling forwards in the London market. Now, predominantly, it was probably forwards in the London market because the London market is far larger than COMEX. But what then happens is that the bullion banks who take the other side of the trade, in other words, they buy the contracts, the forward contracts on London, they will hedge it by selling futures on COMEX. So that is how you see the suppression going through. It's not JP Morgan just going into the market and bashing it. I mean, sometimes that happens, but that's a different thing. But basically, you can see how the interrelationship works. Now, what this means is that if you just analyze the Commitment of Traders reports, you're not getting the full picture. You're only getting a tiny portion of the picture, and you're getting the backwash from a bigger market. So all this analysis of the Commitment of Traders, you really should not take it too seriously. Now, there is another point about this, and that is that at the time there were rumors that this was JP Morgan as principal manipulating the market. Now, that is one thing. If JP Morgan is acting on behalf of a client in the client's interest, then that's something completely different. And I think that distinction is important to understand. Now, just before that conference, I think it was a month before that conference, the conference I attended in New York, there was a lady called Blythe Masters, and Blythe Masters was head of commodities at JP Morgan. And she was a very, very powerful lady. She gave a television interview on CNBC, which I linked to in my article, where she clearly said that JP Morgan does not take directional positions.
That's right.
They only offset what their clients do.
We've heard this one. This has made a big stir and a big ripples across the community of sound money enthusiasts because they saw that as public denial by JP Morgan of what they were really up to. So
yeah, exactly. Now, the point I would make about that is that I have known quite a number of people in the financial services industry of her importance. I don't know her, I've never met her. but I've known lots and lots of people of her importance, of her level, if you like. Now, I can tell you that absolutely no one in that position, no one would perjure themselves for the company by turning around and telling a barefaced lie. And furthermore, if you like, the context of the interview was interesting, because when it came to describing the blogosphere, I think was the words that she used about how, rumors that JP Morgan was acting as a principal. The question was asked by the lady from CNBC, and she said, "Now that's a very good question. Now you and I know from our experience interviewing people that when we sort of pre-agree a question before the actual interview, what happens? I say, that's a very good question." In other words, this was already set up before the interview. Blythe Masters went into that interview determined to make the point that JP Morgan was not intervening as a principal in the silver market, but it was only acting on behalf of a client. And as you say, all the conspiracy theorists, they went into overdrive on this, accusing her of being a barefaced liar and the whole thing. I'm sorry, I just don't buy it. That doesn't make any sense whatsoever. So as far as I'm concerned, it is absolutely clear that JP Morgan is acting as a broker for a very important client. And I must say, the way in which JP Morgan has handled that account, I think is admirable. If I was the client, I would be very, very pleased with the service my broker was giving me. Nobody knows who I am as the client in the market. There have been no leaks or anything like that. Very skillfully, JP Morgan has used both the London market and presumably also the COMEX market and achieved what the client wants. So that's the background to it. Now, there came a point where the strategy appeared to shift, and this is what caught my attention. You had this sudden whale, as I called it, appearing in the concentrated largest four traders who were suddenly net long at a time when you would think that they could be close to or should be close to record net short. So there's obviously a very, very big bull position in there. And it's one bull position because if it was more than one, then the stories would be around the market and nobody else of those large eight would be as short as they are.
Could you clarify, when you keep describing the top four and the top eight, why that's the window through which we're looking?
Well, basically, if you look at the Commitment of Traders figures, you've got it's broken down into two categories of commercials. You've got the producers, and the industrial users. That's one set of professionals, as it were. The other are the banks, who are basically in the swap category, and they trade between markets. They also trade, sort of within the market as well. But basically, that's the bridge between markets. And then you've got the speculators, and it is the speculators who tend to go long. They take the price risk from the producers, and effectively that is the way the market works. It was all set up on the back of agricultural futures way back when Chicago was a center for grains and all the rest of it. And you could imagine that if you've got a harvest, then you've got seasonality in prices, and if as a farmer you knew that your crop was likely to produce so many units of whatever it is, then you could hedge it forward, because you knew as soon as it hit the market, the price would go down. You didn't want that. So the point is that there was the speculators who would take the price risk. The same is in the structure in silver. But the Commitment of Traders figures, which are weekly figures only, do give further information. And what they do is they take, in this context, the percentage of the open interest on the long side, which the four largest traders have, and the percentage of open interest on the long side, which the largest eight traders have. It doesn't say who they are or what category they're in. They could be anyone. They could be you and me if we're rich enough to take on the market, if you like. And as well as that, they show the net, the short position of the four largest traders and the short position of the eight largest traders. Now, obviously, you've then got both sides, if you like, of the four largest and the next four largest, or the eight, and you can take out the second four largest simply by subtracting the four largest from the 8. So that's basically what I did. And it's all recorded in percentages of open interest. So you have to work out, the number of contracts, and then you get a pretty good idea as to what the position is. So that is one of the dimensions, if you like, which is on the back of the front end of the Commitment of Traders figures. So you can see from that, we had this extraordinary position, and suddenly there was this long position built up. Who was it? And that was why I sort of went back to the time when I was in New York and I spoke to those silver producers, and I resuscitated my thoughts from that time as part of what I must admit is a speculative assessment. I hope that in making a speculative assessment, my own conspiracy theory, if you like, as I called it, that I'm closer to the mark than most of the other conspiracy theorists. And that is all I could do, if you like, from that. And the reason this is so interesting is that there is a further dichotomy. We have seen the gold price rise, $180 or something over the period in which we're talking. And yet the silver price has got stuck down there on a gold to silver ratio of well over 90. I mean, what is going on? It is an extraordinary situation. There are other differences. I mean, in gold, there is always a shortage of gold, if you like, deliverable gold in the markets. There is not a huge pile, I think something like 7,000 tons, including gold held in the Bank of England. And I can't remember whether that actually includes the monetary gold, in other words, gold reserves, if you like, for the various countries that the bank is acting for. But, I mean, given the turnover that goes on in London and the forward market, that is a relatively small, highly geared operation. It's a relatively small amount of gold, and it's a very highly geared operation. Silver is slightly different. Silver has got there's plenty of silver in the COMEX vaults, and there's about 4 times as much silver in London. So we've got this background that there seems to be quite a lot of silver around, and you could turn around and say, well, with all this silver around, price shouldn't go up. And not only that, but if you look at base metals, and if we assume that silver is a base metal rather than a monetary metal, what's the hassle? So you can see there are various reasons why people in the market, I think, have become complacent about the future likely demand for silver. Because the one thing of which I am absolutely certain is that as the monetary situation deteriorates, and we're beginning to see the seeds of that. I mean, President Trump even calling for a lower dollar, calling for Powell to inflate, effectively. They're going to try and destroy the dollar, and that's semi-official now. So, where does this leave silver? I think it leaves it horribly underpriced, and that's why I found that it was an, if you like, a good moment to talk about it.
So again, what you see in the actions of the largest traders, what specifically did you see that led you to think that there was this single large interest that was basically taking a position that was a bullish position?
It is extremely simple, and that is that if you look at the net position of the 4 largest traders, they are net long by about 10,000 contracts. And this is at a time when the next 4 largest traders are record net short. And if you look at what's going on in the gold market, you would think that the largest 4 should also be net short, unless there is one of them, and it has to be one of them, I believe, is really super long of the market.
Did you mean the silver market?
Silver market, yes.
Yeah.
Silver market, yeah.
And your thoughts about, again, as long as we're in this sort of speculative arena, what would make one differ so strongly from the others in terms of why it would take such a position?
Well, this is it. I mean, I can see. I sort of tied in another little factor, and I know I'm sort of tying in little factors to build a story, but I think that's the nature of it. You can't do much more than that, and this is why I openly admit up front that this is a speculation. Mm-hmm. But the turnaround in the position of the longs, the 4 largest traders in the market, the turnaround seemed to come in March 2017. Now, at that time, President Trump had been in office for about 3 months, and it was absolutely clear that the establishment wanted to get rid of Donald Trump. They wanted his establishment, his government to fall, his administration to fall, and they were working very hard to do it. Now, if you were China sitting there as a major importer of silver, a monetary metal in Chinese terms, because remember, in China, silver has been more money for the ordinary people than gold has over the centuries. Then under those circumstances, you think, how is this going to affect my strategy when it comes to importing silver? You're bound to. And remember that unlike the other base metals, the import and exports of silver is directly the responsibility of the People's Bank of China, just as it is with gold. So, under these circumstances, I could envisage, and here I'm speculating again, I know, that the Chinese would probably change their attitude towards the price of silver. Instead of suppressing the price of silver, and they would probably consult their broker, JP Morgan, on this, incidentally, because I would believe that this arrangement would be sealed with regular meetings, quarterly, if not monthly meetings, to work out the strategy for the coming period. I think that between them, they would have thought, well, if there's trouble, if you like, at the political level in America with this new president, then this is probably not going to be very good for the dollar. Therefore, on that basis, it's going to be harder for us to continue to suppress the price. What we ought to do is to think in terms of hedging the future price. In other words, accumulating the equivalent, and I say the equivalent, of a position in the futures markets which would cover, for the sake of argument, 1 year's import demand for the Chinese economy. So now that works out about 43,000 contracts. So we're talking, that sort of ballpark figure, which fits in with the likely size of our whale in the market. So you've got a whole load of circumstantial evidence building up a picture which I think begins to look, if not compelling, certainly very, very interesting.
Now, this speculation or analysis or observation, series of observations, series of breadcrumbs that you lined up in a row, stirred a bit of controversy when you published them in the form of an article among those others who are watching the precious metals markets closely. What was the nature of the controversy?
I think the nature of the controversy was that, I've come up with a new conspiracy theory which doesn't match theirs. And the problem is that when you've got a homegrown industry in North America, which is relying solely on the commitment of traders' numbers, then you're not seeing the whole picture. And I was bringing in a new dimension, if you like, which is impossible for a North American-based analyst to really quantify if he is only looking at the commitment of traders' numbers. And you can't quantify it because the whole point about London is it's an over-the-counter market with very limited information. The only information we get long after the event are the daily settlement figures. And of course, you know what a daily settlement figure is like. It doesn't tell you how many trades there were underneath before you got to that settlement figure. And the other thing is the quantity of silver in the LBMA vaults. And that is how I know that the quantity of silver is roughly 4 times that in the COMEX vaults, of which there is a reasonable quantity. So, it's not as if silver is there's not a shortage of silver from the point of view of the vaults. I mean, obviously what we don't know is how much of that silver is actually available to be delivered against forward and future contracts. But on the face of it, there does appear to be quite a lot of silver around. And that is a fundamental difference with gold.
This is fascinating, and I will include a link to your original article in the description of this video for people who would like to dig into it a bit further. And within that, you also have links to some of these other data sets and interviews and so on that if people would like to dig into it further. Alasdair, before we let you go, we also wanted to circle back with you. You've talked with us a couple of times recently about the cryptocurrencies as a alternate non-dollar or a non-fiat alternative. And we've seen a bit of volatility in the last month, especially in the crypto market after it had reawakened over this past quarter, basically the way gold did. But gold has held up a bit better in the last couple of weeks. What do you think what stage of the game are we at here in the crypto world, and what role do you think that's playing for people as an alternative to fiat?
Can I answer that in just one moment before we finally leave the subject of silver?
Certainly.
Ted Butler refuted my claims, if you like, in an article on SilverSeek, which was posted yesterday. I have actually sent to be posted tonight a response to that. So if anyone is interested in the silver subject, you can look at my original article and you will see my response to Ted Butler's points. Okay, we'll move on to cryptocurrencies. I think the cryptocurrency thing is fascinating because to me this is a whole new dimension at a time when I can see a credit crisis which is likely to end up in a systemic crisis and a currency crisis. We have this new dimension called cryptocurrencies, and particularly Bitcoin. It is something which is completely beyond the control of governments. It is decentralized. It is not money. It is probably a store of value as long as people continue to believe in it and as long as the electricity continues to flow through our computers' veins, which is absolutely fine. And I don't know if it'll last forever. I wouldn't make that claim. All I'm interested in is that I think over the next 2 or 3 years, we are going to have a credit crisis. The difference between this credit crisis and the one which I compare it with, which was 1929 to 1932, is the fiat currencies are unbacked this time, whereas in that earlier period, they were backed by gold. So the price effect is very, very different. Now, the question is, if you are, let's say, a holder of money deposits in a bank, and the bank is restricting the pace at which you can take out cash, and you may not want cash anyway, what do you do? Well, the answer is basically you get rid of your currency by buying something. Mm-hmm. You hedge out of it, if you like. And for the first time in all history, we have this paper digital alternative called Bitcoin. And the thing that is also important is that in understanding Bitcoin, you have a whole new generation, a literate, financially literate generation, who have learned about the disadvantages of fiat currency and how fiat currency is a liability of the government. And it only has any value so long as you trust that government, the issuer. So they have begun to understand in a way in which we haven't seen before, as there's a significant element of the general public who now know that paper currencies are going down the toilet. When they begin to see that happening, then they are going to accelerate their movement out of the paper currencies into alternatives such as Bitcoin. Now, Bitcoin doesn't replace gold and silver because gold and silver is still the true money, if you like, for communities around the world, even communities who are not connected to each other. It is the one thing which everybody understands is not only a store of value, but it will be accepted in exchange for goods and services by other people without question. Bitcoin does not really do that. It can't function like that anyway, because the maximum scalability, if you like, is only something like 500,000 transactions a day or something. I mean, it is just not fit for that purpose, but it is fit as a store of value. So it's not that Bitcoin replaces gold and silver, but it's a new kid on the block, which I think could have a very detrimental effect to currencies once the slide starts. And I think this is a very important point. And the ubiquity of it is quite staggering because, someone with nothing but a mobile phone can play this game. They can hedge out of the filthy Indonesian rupiah they've got in their pocket, which which is just going down and down and down and down, or the Indian rupees or whatever. So you can see that here we have something which actually is attached to your mobile phone, and there are 7.2 billion people around the world, and I should think that you could have over 1 billion of them playing this game. It is potentially an extraordinary situation. And extraordinary in two ways. I think that you've got the limited supply because it's getting increasingly expensive to mine Bitcoin. So the supply side is virtually tied. At the same time, it's just going to be a far, far larger opportunity. I mean, if you go back to something like the South Sea bubble,
right.
Which was a major event, if you like, a major speculative event. Now, the people who participated in that had to be within a coach ride of London.
Exactly.
Because they had to go to
their
broker.
Earlier, yes.
Yeah, I'm repeating myself. But you can see the difference between that and a truly global phenomenon. I don't know where it is going to stop, but it's going to be very interesting observing it.
Well, it's always interesting to us to have you on because you bring us not only the UK perspective on things, but also your depth of experience in the precious metals that you've watched for so long and really help us to understand a lot of trends that we might not otherwise know. And your most recent report certainly gets a lot of fuel for our thinking, and really, really appreciate you always, Alasdair, being here with us on Reluctant Preppers.
Well, it's very nice of you to say so, Donegan.
Hey, Reluctant Preppers. If you haven't heard, we've already started our monthly 1-ounce U.S. Silver Eagle thank you gift to one active Patreon subscriber each month, signed by your host, Donegan Kaiser. And you don't want to miss out on that.
Please help us grow by subscribing today at patreon.com/reluctantpreppers. If I own gold or silver, how will I ever be able to spend it?
Oh, sure. Well, consider good times or bad times. Like in good times, you can sell it back to the same place you bought it from. sdbullion.com/RP will buy it back at the best price guaranteed on the internet. You can take it to a local coin shop and get cash in your hand, completely anonymous. Some people may be willing to take gold or silver coins in exchange for goods or services. Now, in bad times, when things have really fallen apart, time after time in history, people have found that in hard times, gold and silver really does come through as something that people recognize as value even after everything else has failed. Your first ounce of silver is at spot price, and you get free shipping on any order over $99 at sdbullion.com/RP.